I'm James Beckwith, President and CEO of Five Star Bank. As a community bank, we believe that open dialogue about the issues affecting our region is vitally important. From the economy to the environment to social issues, we look forward to the conversations and hope you'll join in.
Welcome to Studio Sacramento. I'm your host, Scott Syfax. Phil Angelides has worn many hats in his career. Real estate developer, California State Treasurer, member of the board of CalPERS, chairman of the Democratic Party, head of Riverview Investments, head of the Apollo Alliance, and most recently, the chairman of the Financial Crisis Inquiry Commission that investigated the causes of the crash of 2008. Angelides and his fellow commissioners interviewed over 700 witnesses, held 19 hearings, and reviewed millions of pages of documents in their investigation. He joins us here today on Studio Sacramento. Phil Angelides, welcome to the program.
Good to be here. From that introduction, it sounds like I can't hold a job.
It actually sounds like you're taking up a bunch of jobs that people need. You need to share a little bit. Well, let's get started. Phil, what was the cause of this crash?
Well, to boil it down, as you mentioned, we spent over a year and a half investigating this crisis. We interviewed over 700 witnesses formally and many more informally, held 19 public hearings throughout this country, and reviewed millions of pages of documents that hadn't been seen before. Let me boil it down. It was recklessness on Wall Street and abysmal regulatory neglect in Washington that allowed our financial system to spin out of control and bring our economy and our financial system to its knees in 2008. And it really is a story of Wall Street taking more and more risks, regulators failing to do their job, even though in many instances they had the power to clamp down. Yes, there were some gaps in the regulatory authority, but that's really at the essence of it. And it was accompanied, I might say, by widespread breaches in ethics and accountability, and potential violations of the law that undermine trust in our financial system and damaged our economy very badly.
Well, if there have been all these violations of law, where have the perp walks been? Where have the prosecutions been? The public hasn't really seen any of that.
One of our mandates as a commission, we had three mandates. One was to examine the causes of this crisis. The second was to look at the major financial institutions that collapsed or would have collapsed but for extraordinary government assistance. People focus on TARP, the $700 billion bailout. Right. That was the tip of the iceberg. There were trillions of dollars lent to the banks, given to the banks in 24 different programs, so enormous assistance. And the third mandate we had is when we found potential violations of law, we had an obligation to refer those matters to the Department of Justice or the appropriate state attorney generals. Now, we've made those referrals, and in the interest of fairness and justice, we don't reveal what we referred, but let me just say we're very clear that we did refer matters to the Department of Justice, and this is one of the most frequently asked questions I get. In the wake of all this damage, in the wake of the recklessness we saw, why has there been no prosecutions? Why have we had civil settlements where banks have been allowed to settle for pennies on the dollar with no admission of wrongdoing?
And blanket immunity
from
any future liability whatsoever.
Well, and here's what's, I think, troubling. Number one is, I think Americans need to know the justice system's for everyone, that there's not two justice systems in this country.
There is a perception that in this case, there are two different systems.
Yes, absolutely. And here's my view. My view is we haven't had the kind of vigorous investigation and prosecution that's warranted. We don't want revenge. We don't want hangman justice. Here's what we do want. If there were wrongs, they need to be righted. And we need deterrence. Let me just say, if someone robbed a 7-Eleven for $1,000 and they were able to settle a week or two later for $25 with no admission of wrongdoing, they'd be back at it. And so I do think this has been one of the great disappointments in the wake of this crisis.
Well, let's go there.
Justice has not been served.
Well, let's go there. Are the perpetrators that were discovered, are they back at it?
Well, I don't think much has changed. Let me be blunt about this. I mean, we did an exhaustive review of the years leading up to the crisis and the practices that were undertaken by the big financial institutions in this country. And while the Dodd-Frank bill has been passed, much of it's not yet been implemented. There were some 240 regulations that had to be put in place. And what's happening is that Wall Street is waging a very aggressive effort to weaken regulations, to stop them from going into place. The Republicans in the Senate have vowed to block almost every nominee to key regulatory positions. The Wall Street banks, the big ones, spent $52 million in lobbying in the first quarter of this year alone after the law was passed. Very little's changed. Let me just give you one example. One of the factors that played into this crisis was the role of derivatives. Essentially, these highly leveraged bets made on the financial
contracts,
market.
yes.
Yeah, they're contracts, and they're really bets made on the market. They're side bets made.
Right.
And as you know, there were a lot of subprime mortgages and mortgage securities created, but there were tens of billions of dollars of side bets made on those. That market, which is a $600 trillion worldwide market, is still essentially unregulated today, the over-the-counter derivatives market. So we don't know what risks the financial institutions are taking. We don't know, for example, what kind of exposure we have to the Eurozone crisis. So not much has changed, and there has been a fierce rearguard action by the financial industry and their Republican allies on the Hill to block any meaningful reform.
Well, wait a minute. On that one, I've got to push back a little bit. And the reason is that for those who share your philosophy politically, and obviously you're a Democrat.
Absolutely.
Okay? Yeah. In 2008, Barack Obama was elected with 2 houses of Congress that were also controlled by Democrats. If ever there was a time when it is that the forces that should have been able to put in place permanent, substantial reform, it was in that era, and they couldn't get it done.
Well, let me say this. The Dodd-Frank bill has some very significant reforms, and that was signed by the president and passed by majorities in the House and the Senate controlled by Democrats. It set up a Consumer Financial Protection Bureau. It did require the regulation of derivatives, but it had to be done. It's really setting up a whole new market. It had a number of very strong features. Now, it didn't go as far as I would have liked to have seen it gone. Having said that, though, since 2010, when the Republicans got control of the House, there has been a fierce rearguard action to really stop the momentum of reform. But I will just say bluntly, Washington as a whole hasn't done enough to really reform the system. And I think as importantly, Scott, remake our economy. You would have thought we'd come out of this cataclysm with a rethinking of our financial system and our economy. Yet here we are today, and the 10 biggest banks are more powerful than ever. They control 77% of the banking assets in this country.
Well, let me go to a quote of yours in a recent op-ed that you wrote, and it was around the concept of revisionist history. And you wrote, if you are Alan Greenspan and you retreat from your 2008 epiphany in which you acknowledged your state of shocked disbelief that the whole intellectual office of your regulatory ideology had collapsed. Now, you condemn reform efforts as the current anything-goes regulatory ethos, a phrase that paradoxically recalls your own failed policy at the Federal Reserve. In short, after driving the economy off a cliff, you offered to give driving lessons. But that seems to be business as usual back in Washington.
Well, and there's a big revisionist movement going on right now. I mean, it's very clear. If you look at from the 1980s on and cresting in the early 2000s, there was a deregulatory attitude towards Wall Street. There was this view that somehow their instincts for self-preservation would end up protecting the public interest. There was a view promoted by Alan Greenspan and others that they had learned to control risk, and therefore we needed the light touch of regulation, not a firm hand on this essential core function within our economy. So what's happened strikingly since the collapse, though, is there's been a dramatic effort by people on the right and by Wall Street to revise history, to say this was a result of government housing policy, the Community Reinvestment Act, Fannie Mae and Freddie Mac. Now, let me just say something. Fannie Mae and Freddie Mac were disasters. They've cost the taxpayers $130 billion. They made tremendously bad bets from 2005 to 2007 on the subprime market. But 9 of 10 of our commissioners, including 3 Republicans, found that the Community Reinvestment Act was not a significant factor in this crisis,
But
and
yet
that Fannie Mae and Freddie Mac were not the primary cause. Yet this is the reigning rhetoric of every Republican presidential candidate, people like Michael Bloomberg, who defends Wall Street, and a lot of the folks on Wall Street.
This is also the rhetoric, though, of also people in the general industry of the housing market as well, which is that CRA, trying to empower people into home ownership and the like from traditionally underserved communities, is just a unalloyed bad, and that all those folks should be renters permanently. What's your view on that?
So a couple things. So first of all, I'm going to be clinical. One great thing about our commission work is we looked at facts, and facts can be troubling phenomena for pure ideologues. And I went into this, by the way, forget my party registration, with eyes open, willing to look at the facts. And here are the facts. The Community Reinvestment Act really applies to regulated banks and thrifts. Most of the most aggressive subprime lending in this country was done by the New Centuries, the Ameriquest, all the unregulated institutions.
Countrywide.
Yeah, well, Countrywide was subject to the act, but most of the aggressive subprime lenders weren't even subject to the act. Studies have shown that about 6% of subprime lending was done under the Community Reinvestment Act, so it wasn't the driving force. With respect to Fannie Mae and Freddie Mac, I think the facts, again, are pretty clear. They followed, not led Wall Street into the most egregious kind of predatory subprime lending. When you look at how their loans performed versus how the Wall Street subprime loans performed, there's a world of difference. For example, take a similar borrower with a 660 credit score. The default rate from Wall Street securitized loans were about 28% by the end of 2008, 6% for the same kind of loan for Fannie Mae and Freddie Mac. So facts are facts, but there's a very deliberate effort by Wall Street and their allies to revise history. And I think one of the most powerful, characteristics of our commission's work, the thing I'm proudest of, is we have written a definitive history of this crisis. And while people may disagree with our conclusions, no one has yet found an error in fact in our 575-page report. Not one error in fact. And you know that there's been a swarm of lawyers, others from the financial industry looking for any mistakes we made. So the facts are the facts, and the history speaks for itself.
Well, the Commission's work is a far more complicated analysis. But when I read people like Gretchen Morgenstern's recent book, the writer for the New York Times, she lay the crisis almost squarely on Fannie Mae and Freddie Mac. The other piece of it is other writers, the CRA and the like. What did the Commission find in terms of how far up and down the food chain this crisis emanated from?
Well, look, first of all, were there reckless borrowers across this country? Absolutely. Mm-hmm. And did it happen at the local level where the mortgage brokers were being paid, called yield spread premiums? They were being paid to put people in the most expensive loans. So did things happen at the ground level? Yes. But in the end of the day, when we look for responsibility, you have to look to the top, the generals, the people who are charged with running these large financial institutions. And I might add, being paid, like Martin Sullivan at AIG, $107 million over 3 years, or like Robert Rubin at Citigroup, being paid over $120 million in his role as chairman of the executive committee. In the end of the day, it was the CEOs, the people leading these institutions, who led them down the paths of reckless action, reckless lending, reckless speculation. And you do have to lay blame at the key policymakers, the Alan Greenspans, who stood by and watched as this rampant speculation took hold. So in the end of the day, you do really have to look to leadership, even though, of course, throughout this country, whether people were speculating on homes, borrowing recklessly, there was broad participation. But I want to say this. In the end, you have to blame the lenders the most because they made the loan.
That's true.
And in the end of the day, it was the American taxpayers who rode to the rescue of Wall Street, trillions of dollars, not to homeowners across this country. I mean, there have been over 4 million foreclosures to date in this country. Here in the Sacramento region, since January of 2007, 80,000 homes have been foreclosed on.
80,000.
Yeah, that's almost, by the way, that's about 16% of the homes in the region. And look, it's continuing to go on. In October of this year, there were another 3,300 foreclosure filings in Sacramento County. That's an annual rate of about 38,000. It continues to go on. The crisis has never ended.
So let's go back to the number 52 million, the amount that the financial services industry has spent in the first quarter of 2011 in their participation in the regulatory process in DC. 3 weeks ago, I was in New York City right before the Occupy New York site was shut down. And I've had a chance to talk with people who are involved in that movement as well as the Tea Party movement. And one of the things that's interesting about both, where there's a commonality that was actually referenced recently in the president's speech, is that it appears that while both have very different perspectives, there's a core where they're railing against the same thing, which is that the effective powerlessness of the average American to really impact policy and get justice from the federal government in Washington. What have you seen in terms of the exercise of the power that exists in DC?
Well, Scott, when you were saying some of the things I'd done in my life, including running for governor of the state, let me just say, when I was appointed to this position, I thought I knew something about our financial system. I'd been treasurer of the largest state in the country. I'd sat on the board of the two biggest pension funds in this country. I'd obviously been politically engaged. I'll just be blunt with you. I was shocked when I got to Washington.
Why?
Well, I was shocked at the power of the financial industry. One lawyer for one of the big banks out there bragging that they spent more on their lawyer fees dealing with our commission than our entire budget. I saw an army of lawyers, lobbyists who were pushing back on our work all the time. I was really stunned at the extent of their power. I also want to tell you, I was stunned at what I saw in our financial system. Like I said, I'd been in the private sector, I'd been in the public sector, I'd been around finance. I actually had this quaint notion that our financial system was about deploying capital to create jobs and enterprise and wealth in America. And what I felt like when I got to DC is I felt like I'd walked into my local community bank, I had opened a door that I wasn't supposed to open, and I saw a casino floor as big as New York, New York. Our financial system had increasingly become about risky trading, speculation, not about providing lending and capital to build America's businesses, to create jobs, and it was really quite a stunning revelation.
And how much of that is different today than when you showed up in Washington?
Not much. Not much. The lending isn't there. These big
the American
financial
people are still at risk.
Yeah, it's kind of like right now, though, the boat's tied up to the dock because the economy is very slow. But the minute that boat moves out from the dock, I suspect you're going to see that we're going to be in very choppy waters. And of course, we're at risk today. Look, the Eurozone crisis is going on. Because derivatives are still hidden, we don't know today whether one of the big financial or many of the big financial institutions have made bets for or against the Eurozone bonds. We could be exposed to $150 billion. We could have exposures of $1 trillion.
So you're saying that if Greece goes down or Portugal goes down, the implications potentially put us in the same situation or maybe worse than what we experienced in 2008?
Well, we don't know because these over-the-counter derivatives are hidden. And what happened is, AIG, which has cost the American taxpayers about $180 billion, we rode to its rescue as a nation because they had made a whole series of bets on subprime lending. And when those went bad, we had to wade in to prop up that enormous insurance company. If some major financial institutions have bet that Euro bonds will be supported, but then some countries default, there could be enormous implications that ripple across the Atlantic.
So let's go back to the Commission's work. Name 2 or 3 things that you're disappointed that have not been followed up on that the Commission discovered in the process of its deliberations.
Well, let me just say that when we wrapped up as a commission in February, we made our referrals to the authorities. I'm now a private citizen, so I'm not privy to the investigatory work that's continued. I think I've been generally disappointed at the zeal, the speed, the resources that have been applied to ferreting out the wrongdoing that occurred in our system. Look, if you read our report, and I know you have, and I hope others do, by the way. It's you can buy it
It's
in bookstore.
actually much more interesting reading than one might expect.
Well, we worked hard at that, by the way. I mean, and we worked hard at having a book that could be read not just by PhDs and people on Wall Street, but by Americans from all walks
It
of
was
life.
very accessible and approachable.
And by the way, it's on the web at fcic.law.stanford.edu. Stanford is the repository, and so people can of our archives, and people can download the report. There are also thousands of documents on that report. So, I've been disappointed at, I think, the vigor with which justice has been sought. I've also been disappointed that in many areas where we pointed out fundamental flaws like the derivatives market, like regulation of the shadow banking system, this massive banking system that wasn't regulated like traditional banks and thrifts, that we haven't seen the kind of movement we need to see to get Wall Street under the kind of regulatory framework that will protect our economy. In some ways, the financial system's like the heart. You want it to be stable. Right. Look, I come from the private sector. Business is about taking big risks, succeeding, failing. But in the financial sector, particularly with too big to fail institutions where we pay the bill, we want prudence, we want stability, and I'm concerned it's not there yet.
Okay, in our last few minutes, I want to ask you a question that constantly gets asked but never answered, which is, Wall Street got its bailout, Main Street didn't get a bailout, and neither did the homeowner. And there's a basic sense of unfairness throughout the land. What's been left undone that needs to be addressed and a part of the 2012 conversation in the national elections?
So it's more than just unfairness. It's what's right for our economy. We're not going to have an economic recovery until we get the housing market stabilized. Right now, about 25% or so of American homeowners with mortgages are underwater. Here in Sacramento, it's about 40%. In San Bernardino, Riverside, it's in the high 40s. There's a $700 billion overhang of families that have negative equity. And as long as they can't refinance, as long as they have that crushing debt burden, the economy won't lift off. What we need is a massive program of principal reduction so people can stay in their homes. Those mortgages have already lost their value. And it's time to write down their value so more people can stay in their homes. We can allow them to refinance. We can get rid of that big debt overhang so they can begin spending in the economy again. The current housing market model is we're moving more and more homes to foreclosure, deteriorating neighborhoods, leading to public safety issues, declining the value of homes.
And the tax base.
And the tax base. It's a disaster, and it keeps going on. The first wave of foreclosures were people who probably couldn't afford to borrow for a home or were given and got predatory loans. The second wave were the 9 million people who lost their jobs. The third wave now are the millions of homeowners who are so deeply underwater that at some point they're just going to walk. And until they do, they're not maintaining their homes, values are deteriorating. So we need a fundamental, and I would say radical approach like Franklin Roosevelt undertook in the 30s to reset the clock for homeowners, just like we did for the big banks.
Let me give you a scenario that happens every day that appears to many to be ridiculous. A homeowner is underwater, gets behind on their mortgage. Their $100,000 home, we'll just use that as an easy number, they can't pay their mortgage, but they could pay a $70,000 mortgage with a wholesome 30-year fixed mortgage. They lose their home. It goes into foreclosure and into REO status where it's owned by a bank. And then the bank sells it off for somewhere between $55,000 and $65,000.
The current model's broken. And the thing is, we built this big doomsday machine, as you know, of millions of mortgages were securitized, sold to investors, sliced and diced. And this doomsday machine keeps churning along. And
why is this happening? Why it doesn't make sense?
There's a lot of legal reasons, but we got to break it. And I want to say something about Occupy Wall Street, because I had the chance to go to Zuccotti Park. I got taken around by some of the young people. I give them real kudos. They've helped change the debate in this country. The President of the United States this week, spoke out about the income inequality that's pernicious. They're focusing on this home foreclosure. Thank God we have a democracy where people can take to the public square. And for all those big shots on Wall Street who condemn them, just remember, we applaud young people around the world who take to the public square to speak out for change.
That's a good point. I want to bring us back to Sacramento.
Sure.
Right now, Sacramento's economy has had significant challenges. You point out the scale of the housing problem that we've got here. There's a group of folks trying to envision what the next economy of this region looks like and migrated off of being so dependent on the government. We have about 30 seconds. What advice can you give them from all your travels as to what they should be focusing on in order to create a more vibrant economy in this region?
The high road. We ought to be looking at the best schools, the university clusters, attracting to this region innovators, job creators, risk takers, so we can build an economy where we produce goods of value and jobs that have good wages. Jobs that have good wages, so Sacramento is known as a place with a broad middle class and real stability beyond its government foundation.
And you've stayed. We're happy about that.
Well, I got a beautiful granddaughter. I've got my father and my wife's parents are here. This is our home.
All right. Okay. And finally, if you're looking forward to the future, what is it that you see nationally in terms of our economy over the next few years? When do you think we truly get to recovery?
So here's
You
what
have
I
about
think.
30 seconds.
30 seconds. First of all, we need justice because we need to set right what's happened in the past. We need real financial reform. We need to remake, not just rebuild the economy. We can't just pump it up. What we need is a broad middle class. We need to make things in this country. We need to educate our workforce. We need to become competitive.
All right. We're going to have to leave it right there. Thank you,
Thank you
Mr.
so much.
Angelides.
Thanks, Scott.
I'd like to thank our guest, Phil Angelides, for joining us. And thank you for being part of the conversations that matter. I'm Scott Syfax, and you've been watching Studio Sacramento. Join us next time right here on KVIE.
I'm James Beckwith, President and CEO of Five Star Bank. As a community bank, we believe that open dialogue about the issues affecting our region is vitally important. From the economy to the environment to social issues, we look forward to the conversations and hope you'll join in.